All right, good morning. Seems like a few of us are late today, so let's maybe give it 1 or 2 more minutes and then we'll start.
Good morning.
Hi, good morning, Tom.
Mhm.
Okay, so I think we can start. Do you have any questions? All right, so let's see where we were last time. So we were discussing the American option last time. So basically, the feature of the American option is following, right? That you have two things, a payoff function, I believe we use the notation phi, right, of x. And then, so features, right? We have a payoff function, and we also have a time window from 0 to t. And, t can be infinity. Homework is still due at the end of the day, right? As usual. Did I say that? That was not put on the homework. This is usual. Yeah, end of the day. Oh, there's no due date. Okay. All right. Yeah, and end of the day as usual. I mean, if there's some reason you you need some more time, let me know. But yeah, as usual, is by the end of today. Yeah. All right. So for the time window from 0 to big T, right? Then we choose the stopping time, right? We look at the set of stopping times. Tau, right, on 0t, and our task, right? So vt, oh, sorry. Maybe I need to say something like, well, I don't know, should be time window from little t to big T, I guess. Okay, so vt then is going to be the max over all such stopping time of the discounted payoff. Like that. Okay, and so our goal is to characterize VT. And so there are several things that we can say about VT. So first, in terms of the martingale property, then we have following, right? That in general, e to the minus RT VT is a super martingale, right? So the reason is as little t, right, moves to big T, we have less and less chance to optimize our payoff. So that's why, right, when you look at the discounted payoff, the discounted value process, it tends to lose value in general. On the other hand, there is, right, some optimal stopping time tau star such that, well, first of all, so actually, right, this tau star technically depends on t, right? So that Vt will be the discounted payoff from this optimal time back. Okay. Well, but characterizing tau star, right, may be difficult. Okay. But one thing, right, that we know is that up to, right, time tau star. So here's this, right? From time 0, right, up to time tau star, e to the minus RT Vt is a martingale. Okay. So in other words, it's a super martingale in general, but up to that time where you, the first time, right, is so tau star basically is the first time that we exercise the option. After time t. Okay. So in other words, from time t to time tau star, not including tau star, then we do not exercise. The option. So anyway, because of this, right, we do not exercise the option from time t to time tau star. From our point of view, the option should not lose value. Okay, the value of the future value of the option should be the same as the current value. I mean, so I should say this maybe. E to minus r, what do I want to say here, right? I should go back to time t because basically my time window is like this. So I should say this. Okay. So basically the discounted value, right, back to time little t, right? This is u bigger than or equal to t. The option does not lose value from time t to time u. Okay. If you look at the future value from the point of view of time little t, then the option does not lose value at all. The third, right, has to do with how to categorize this optimal stopping time. And the most generic way is exactly this one right here, but it's a little bit useless. So it's the first time that we exercise the option. So in other words, right, tau is the first time, let's say this, that the option value is equal to the exercise.
Hello, Professor. I
Yeah.
would like to ask that what the signal inf means.
Oh, sure, Sharon. So inf, right? Inf and sup. So inf, for a lot of purpose, you can say is the minimum. Sup, for a lot of purpose,
Oh,
you can think of as a maximum.
I see.
The
I see. In the homework there is a signal inf. I think it means the infinity, and I feel confused. I know it now.
right,
Thank you.
right. No. So for infinity, we would write this, right? We won't write inf.
Okay.
So the reason why, right? I hope you see why for example inf is used. So for example, if you have the set 0, 1, right? The minimum over 0, 1 does not exist. You see that? Because you can go, right, as far as you can to the left and never have a smallest number in that set. Okay. On the other hand, the infimum over 0, 1 is equal to 1. Does that make sense? The same way for the sup. The sup over 0, 1 does not exist. Well, of course, right? The trick is because we purposefully do not include the point 0 and 1 into this set, right? This is an open interval. Because it's open, right? You can go as far as to the left as you want, and you will never have the smallest member. That's why a minimum, right, by definition, is the smallest member of the set, does not exist, right? So this notation is invented to, sorry, not the sup, right? The max. The max does not exist, but the sup. Oh, what am I thinking, right? This is 0 and this is 1, like that, right? So yeah, but you know, like for a lot of like, if you just want to have an intuitive thinking about this, it's just the first time, the minimum, right? So tau star here means the first time after t that v equals to the exercise time. So in terms of meaning, it's the first time that we exercise the option after time t. Well, but this is useless in the sense that if you want to search for this value itself, right? If v is unknown, then this is useless because how do you don't have v to begin with to find, right, this time. So a lot of times, right? So that's why I say tau star is hard to characterize. So a lot of times we need, right? We may need alternative characterization of tau star, right, to work with. The American option. All right. So concretely, right, the example is the perpetual put. So the perpetual put basically put t to be infinity, the payoff function is k minus x plus. And because the time t is infinity, and the Black-Scholes model is time homogeneous. what time homogeneous means is this, right? If you look at, right, for u bigger than or equal to t, su, right, is st e to the, let's look at risk neutral, r minus 1/2 sigma square, right, times u minus t plus w tilde u, sorry, plus sigma w tilde u minus w tilde t, right? So this right here, right, is a normal with mean 0 and variance u minus t. So in other words, right, that if you look at su over st, okay, that only depends on u minus t and not t itself. In other words, right, if you start at time little t and look forward to how the stock moves, you know, let's say 2 days after time t, then you see that, right, where you are, time t here doesn't matter. It just matters how long has, you know, the future become after that time that you observed. You see, here this also depends on only on u minus t. That's what we mean by time homogeneous. Okay, and because the model is time homogeneous, right? When you look at the option, right, and also because big T is infinity, right? So basically, okay. First of all, the Black-Scholes model is time homogeneous. Actually, a consequence of this is V, right? Vt itself, the value of the option, depends only on t minus t, the time to expiration. So technically speaking, right, it depends on little t, but I hope that, you know, you see from your, you know, you know, like working on your homework, that most of the time you see that this term actually is the one that show up, right? So that explains why when t equals to infinity, you see like this actually doesn't show up anymore, right? So when t equals to infinity, v is independent of little t. All right, so that's just a remark. But anyway, right, so in the perpetual put, we have our v value only depends on the stock price, right, and not depends on the time. All right, so then we, because of the martingale, right, because of the martingale characterization, super martingale, right, and then a martingale up to time tau star, what happens is this, that so characterizations of v of x, right, that basically, so first of all, right, you have the fact that it's going to be a super martingale, like this, okay? So the drift is negative in general, right? This is the dt term. Right? So you have something dt plus something dw tilde t. This is the martingale term. So to make it into a super martingale, this term must be negative. But then if, right, on the set where v is strictly bigger than the payoff function, what we have is that this is exactly a martingale. Okay. So these two together, right? 1 and 2 gives you something called an obstacle equation, obstacle ODE. Right. So basically you want to, roughly speaking, right, solve for a ODE, if you will, right? Because this is a differential equation. But it only holds when your value function is above some value, right? In general, it's like this. So the very interesting thing is that somehow this has a solution, right? So interestingly enough, 1 and 2 have closed form solutions, right? So from notes and last week's review session, I only want to highlight, okay, one particular feature, because in the review session, and I think on the homework, you have a chance to kind of play around with that solution. So I won't really go into it again, right? You get to see how, right, all of these features are satisfied, right? Checking explicitly that it works. But the most important thing is this: there is this interesting object that comes out called L star, right? L star. So actually, one of the most interesting feature that comes out of this solution is this: that basically you have that v of x, right, is equal to some function, okay, when x is bigger than L, let's say, and then is equal to k minus x. So I guess L star, right? K minus x for x less than L star. I guess we can put equality here. Okay. What does that mean? So I mean, like, this dot dot dot, right, is what you want to solve is a times something, right? A times some power. We don't care. What this means, right, is that, notice, of course, this is, or you can say k minus x plus, right? But of course, it's, so what this means is that this is the exercise region, right? This right here is the exercise region. So what we're saying, right, is that we exercise the perpetual put when the stock price, right, is low enough. How low is low enough? Well, when it's below this L star. Okay. Well, so first, let's see if this makes intuitive sense. First of all, right, this is a put option. So of course, right, the lower the stock price, the more you get paid. So yeah, it seems okay, right? That you know, like, you probably will exercise if your payoff seems substantial. On the other hand, right, this right here though is a very interesting characterization that helps you get a hold on the tau star, on the optimal time. This gives, right, an alternative to finding tau star. Of course, if we know L star, right? So remember, before tau star is the first time. So now, because V is independent of T, right? It doesn't matter. We can just start from time 0. The first time that the payoff, right, is equal to, I guess, the put, right? But we don't know this object, so that's not going to help us. Now we can say, though, right, that tau star is the first time that the stock price itself is below L star. This is much better. Of course, again, right, it's much better in the sense that if L star is known, then this guy is known. But let's not be pretentious here, because if you do not solve for this equation, right? If you do not solve for this equation and you don't know how to, then this L star is as mysterious as this guy. Does that make sense? But right, I mean, like for me, having an alternative characterization, right, based on only the stock price itself is much more intuitive than somehow characterizing it as a first exercise time. All right, because the first exercise time entirely depends on the value of the option, which is unknown. Here, well, okay, it's still unknown, but somehow I feel like the L star is kind of more friendly to think about. That's all, right? But of course, if we don't know L star, then this whole thing is not that helpful. Anyway, right? So one important thing is, of course, these two guys are one and the same thing. And in the homework, right, you're asked to verify that statement that yes, right, they are the same thing. Okay. And then second of all, right, what does this L star look like? Well, this L star, it turns out, right, is 2R over 2R plus sigma square times K. So, all right. So your task, right, when you see this formula. So what I want to say is this: when you look at some solution, you may not need to look at all the ways it's solved. Some of these details are technical, but at least you should try to see a formula and see if it makes sense. Okay. So again, I don't know if you have thought about this or discussed with your TA about this, but looking at this, right? Remember, L star is the time, right? That the barrier, right? That we would exercise the option as long as the stock is below L star for our put. Ooh, is that why you cannot do the homework? I think, let me check. That probably it. What question was it? Number 2 or number 1?
It's problem 2.
Ooh, I apologize. I did not know that. That might change the whole. Hold on, let me take a look real quick.
I just assumed that I knew that was a call, but I just tried it out and it didn't work out. So
I deeply apologize. I see why. So Dawn let me know that she has a problem. It is a put. Is a put, right? So it's came as
yeah.
Sorry guys. I mean, yeah, I obviously don't mean to call there, but somehow is that okay? So yeah, 2A definitely is a typo.
All right. Okay.
Yeah.
All right. Just want to make sure. Thank you.
Yeah.
Does that also go the same for part B, where it said ST is equal to L star, but it should be ST is less than or equal to L star?
That's fine there, actually. You know why? Because
okay. Oh, I see. Okay.
because, you know, basically, right, L star is should be about below S naught, right? And the stock is continuous. So the first time you're below is the first time you hit, right? So equal or less than equal to here actually is okay, right? Unless like S0 is below L star, then it's not the same, because the first time you're below is not the same first time is when you hit, but here is fine. Yeah, but yeah, 2A, I apologize, 2A definitely is wrong. Okay, so that explains why. Okay, so go back to here. What properties you think L star must have, and do you think that it's satisfied in this formula? So looking at L star, right? What property should L star have? Okay, thank you, Sherry. Of course, L star should be positive, right? So that works. So okay, so L star should be positive. Let's list it out. Check. Anything else? Smaller than S0. So here's the thing, right, Xiaoran, I agree, right? I agree that essentially should be less than S0, but if it's bigger than S0, that just means you exercise right away. So that, you know, right, I mean, like, you could be in a very strange territory, right? That your stock price is so low that you exercise right away. So I would say that that seems to make sense, but somehow the logic doesn't force it, right, to be like that. So not quite, but yeah, I agree in general, right? I mean, just to make the problem non-trivial, but I would not force it. Less than 1 is not quite it, right? Meow. Well, less than what? Because L star doesn't have to be compared to 1. What should L star be compared with? Not 2R. Again, right? Think about, put yourself into the put option holder, right? You're here. What are you trying to do? You're trying to maximize your payoff. What does your payoff depend on? Your payoff depends on the relation between your stock and the strike. So let me ask, right, a very simple question. Exactly, right? Would you ever exercise if your stock is above K? No way, right? Because you have no money. So one condition is L star must be less than K, right? Is that true? Yes, right? It's less than K because this quantity is less than 1. Okay, but notice actually, if you look at the analytical solution there, right? In the whole process of solving it, we did not really impose L star less than K. It's more of a reality check. But it's kind of amazing that the solution comes out making sense. All right. I mean, of course, right? The correct solution should make sense. But I'm just saying that if you look at the math, the how you try to match, you know, this and that, if you look at the notes, again, I'm not interested in, you know, going through the technical details with you. It's just kind of tedious, right? This L right here was not anything that is imposed like that, less than K, where it comes out making sense. All right, very good. Now, so these are easy, right, observations, and you see it works. Very good. Now let's look at a little more advanced relation. How does L star depend on, let's say, let's make it easy, right? R and sigma. And does it make sense? And when I say how does it depend on, I only ask for very simple relation, increasing or decreasing, right? So maybe let's first look at the relation between L star and K. If K increases, what happens to L star? L star also increases. Does that make sense? I guess it does, right? Because if your strike is higher, then you can afford to, not wait as much because, the payoff, right, is already substantial, right? But if K is low, then of course you have to wait until the stock goes low enough, right, to get an optimal solution. So K star is increasing in K, right? Sorry, L star increasing in K. That's kind of the trivial solution. I think that makes sense. How does L star depend on sigma square? What does that mean, and does that make financial sense? What does that mean? If sigma increases, then L decreases, right? What does that mean in finance? Or what does it mean in how do you interpret that? The more volatile the stock, the longer you can afford to wait. Does that make sense? You think about it. You have a perpetual put. Why is it so down? Why is it that the more volatile the stock, the longer you can afford to wait? Why is it that if the stock is more volatile, then you can wait less? Then why shouldn't you, right? Be a little bit less ambitious, right? Why is it that if the stock is more volatile, you can be more greedy? You can be greedier, if you will, right? And then wait more. Why is that the case?
If it's volatile, then we would expect
what?
I'm just trying to think. We would expect us to like take a longer time to reach L.
Not quite, right?
Because then actually I don't know why, I'm sorry.
No, it's fine. But you see, are you seeing the crux move here, right? Is there something? Okay, maybe let me go back, right? And say, okay, so in the perpetual put option, yes, Cherry, yes, right? But let's put the obvious. Actually, that's not a silly question. But the silly question is this. Why don't we wait until the stock hits zero? Right? It's a perpetual put, right? You have eternity to wait for, right? Which is, of course, not realistic, but that's the setup here. So question, right? The silly question really is, why not? Why not L star equals 0? Why some sophisticated L star like this? Why not 0?
because that would mean K would be equal to 0, but then that means there would be no strike price.
Not right on. Like, so here, right? What this is not a forced relation. This is a proposed relation. You should look at this as L on K, right?
Okay.
So what I'm saying, so the context is this: K is fixed, right? I'm proposing that L star is equal to this as one option. Yeah, I'll get to you, Sherry, right? But what I'm saying is, right? So yeah, maybe you're not getting a hang of what this is. So here's the idea, right? Suppose you start out somewhere here, right? This is S0. K is somewhere here, and you know K can be below S if you want, S0, right? And so you start out, here's your stop. And you have eternity to wait. Okay. So now look at this picture. Right, and this is also an answer to you, Sherry, right? If you have to put a handle, right, on when you want to exercise this option, right? And of course, exercising means what? You get a payoff that is the gap, right? That is below K, right? Where would you put that, you know, dividing line? You know what I mean? So your payoff, right, is the gap between your stock price and K. And I mean, you could put K right as S02 if you want. But anyway, right, somewhere here. So I would argue, right, that intuitively, I think it makes sense that you pick some level, right? That if the stock, so this is your L star. If your stock is below this, or, you know, so I guess who asked that? I'm not sure it was Don or you, right? Asked about equality, right? Rather than less than. It's the same because actually in our mind, right? It's the first time that the stock price gets to that level L. So that, you know, the gap of the payoff is K minus L. Does that make sense? Because, right, I mean, if you look at, I guess in the put context, I guess that's what you're saying, Sherry, right? That it does not make sense to wait for the stock to go above some level because, you know, that's the wrong direction with respect to the put, right? But then my question is, right, within this context, why not wait for the stock to hit 0, right? Why is it that you wait for the stock to hit some level like this? Any idea? Because, right, I mean, like, if really this is the right solution, then what we say here is wrong, right? This is not optimal. It's not optimal, meaning this does not maximize our payoff, right? This should maximize our payoff. Answer? Because there is a cost to waiting. What is this cost? What is this cost of waiting? Or what's the cost for time in finance? R, time value of money, right? Because you see, the lower our L star you set, the longer you have to wait for the stock to go that low. But of course, that will make your payoff higher, except that when you, well, you see, look at this. If R is equal to 0, then what's K? Oh, sorry. If R is equal to 0, what's L star? Correct, right? If there's no cost for waiting, then you can afford to wait forever, right? So actually that entirely makes sense, right? So the longer, right, the longer you wait, the less time value of money for you. Of course, right, there's a balancing between how much you get back, right, from the payoff, but how much discount you have to pay for the cost you wait. So that, right, drives us to maybe, right, so first of all, maybe let's say this, right? So how does L star depend on R? How does L star depend on R? Is it increasing or decreasing in R? When R equal to 0, then L star equal to 0, right? If R gets quite large, now, I mean, it does not make sense if R goes to infinity, right? Because interest rate, I guess at most 100% or so, even we don't see that. But just for the sake of argument, right? If R is pretty large, what does L star approximately becomes? If R is pretty large compared to sigma square, right? What does L star approximately becomes? If R is pretty large, you see, compared to sigma square, then this quantity is approximately 1. So L star is approximately K, right? So if R equal to 0 is 0. If R is large, is approximately K. So L star is an increasing function in K, in R. Does that make sense? So in other words, if R increases, then L increases. Does that make sense? Does that make financial sense? If the cost of waiting is more expensive, you cannot afford to wait as much, right? That makes perfect sense. So now let's go back to this question. We concluded that L star is decreasing in sigma. That means the more volatile the stock, the more we can afford to wait. Does that make sense to you now? Can you kind of see how all of these are put together? Why does this make sense? So the reason is this, right? That, of course, you see that the lower you set the L, the longer you have to wait. So the more cost you have to pay, right? In terms of R, right? In terms of time value of money. Except that, you know, what does more volatile mean really in practice for the stock? What does it mean for it to be more volatile? To be more volatile means it must have bigger swing, right? So compare with this, if I have a stock like this, right? This one is more volatile. So if the stock is more volatile, then it can compensate for a time waiting by having a larger swing, right? So if you have a larger swing, then of course, even though you set a lower barrier, the time it takes for you to get there is not as long, right? Because you have a larger swing. Does that make sense? So in other words, right, if you have a more volatile stock, your swing is wider, you can afford to be a little bit more greedy because you won't have to wait as long for it to hit that barrier, right? In view of the cost of waiting. So everything now makes perfect sense in terms of how this comes together. Any questions? Okay, so let me finish this, right, by just saying a few words on the situation when t is finite. So if t is finite, okay, then first of all, our value will depend on time. All right. So what we have then is going to be a PDE instead of an ODE. So what we'll have is, right, minus RV, right, plus V sub t plus V sub x Rx plus 1/2 V sub xx sigma square x square is negative, right, in general. And this entire quantity is going to be 0, right, when this is true. Okay. So looks innocent enough, right? Looks like we have the same thing as we had before, except we have this extra term, the derivative with respect to time. Guess what? Just one small change like that changes the whole thing. First of all, as far as I can tell, no closed form solution. So none of this nice business of knowing what it looks like explicitly. We don't know. I mean, of course, like you can use numerical approach to solving this, okay? And actually, to solve this, and actually that's the whole point of like a course like numerical analysis, where if you know the method and you can implement it, then you can solve this problem. Second implication is that L star, right? That optimal will now be a function of t minus little t. In other words, right? So what happens is this. Before, it doesn't matter where you start because you have eternity to wait. Now, right, if you start here, then this is your absolute, last minute. You cannot go beyond that. So it makes sense, right? You see that as t goes to little t, then L star should be increasing, right? I mean, obviously something like this should still be true. That doesn't matter what little t is, this barrier, right, will always be below the strike. But the closer you are to the expiration, the less you can afford to wait, right? So therefore, you know, like that. But do we know what it looks like? The answer is no, right? We don't know what L star T minus T looks like. So in other words, we don't have a closed form solution for that either. And so, I mean, I still expect something like this to still works. In other words, I mean, not this structure maybe exactly, but it still should be decreasing in sigma and increasing in R. That should still hold, right? But how does it look like? We don't know. So what's the point? The point is, you know, relaxing this big T, right? Let it go to infinity, letting it go to infinity allows us to have a explicit, right, structure of everything to explore and play with. Nevertheless, right, the idea is still there. In other words, even in a finite situation, right? And here, you know, you should use your imagination. For example, right, if you have to solve a problem for your boss, and you notice that this gap is pretty large, let's say 2 years, I don't know, right? I mean, large is subjective, but suppose you have 2 years left, you know, to expiration, then I would guess that if it's 2 years is large enough for you, then maybe then this might look like a perpetual option. In other words, you say, you know, that's a long time. I can maybe use the solution to the perpetual option to approximate this situation I'm having here. That's one thing you can do, right? Another one, of course, is when, you know, when T is really finite. In other words, when this is, you know, a couple months, you cannot really cheat and say that's a perpetual option. You can still kind of, you know, try to explore by saying, you know, I still need only to wait until the stock gets low enough, right? This is still the key, meaning, right, the optimal exercise time should still be the first time after T such that the stock price is below this level. Except that now, this we don't know. But again, I would argue, right, that knowing that truly all you have to do is waiting for the stock to get low enough is really comforting, because, you know, it's much better to think about than thinking about, you know, the first time to exercise, because that really for me seems to carry no information, right, besides just a definition that everyone knows. All right, so that's the last word I want to say about, you know, finite time option, right? And really the key message, right, for this American option thing is not for you to learn about perpetual put and call, things like that. They are basic stuff, sure. The key, right, the key idea, and I cannot say too much about this because we have other things to talk about, but how to deal with the American feature on a financial product. All right. So the point is American feature, meaning that the user, the holder, can choose whenever they want to exercise the option, whatever that means, right? And so, for example, I mean, I guess we see this all the time, you just don't pay attention. If you take out a loan, right? Let's say the loan is a 3-year terms or 5-year terms, whatever, you know, buy a house, buy a car. Do you, right, you as a loan, you know, taker, you have to wait until 3 years to pay off that loan? No, right? You can just pay off the loan in 1 month if you have enough money to do so, right? So actually, in some sense, you have the American feature there, right? You can choose the time to pay off your loan. Now, why does this matter to the bank? They lend you the loan, right? Expecting a revenue stream from now until, right, 3 years. But if you pay off the loan in 1 month, then the revenue stream is cut short, right? So in that sense, I mean, what interest rate they can charge you, for example, of course, they cannot charge you too high if you have good credit, but the interest rate in general, right, which is the price they charge you for taking out this loan, may have to take into account this American feature, right, on the product, meaning you don't have to wait the whole 3 year, right? You can exercise early and pay off your loan, right? So that's one thing. Another, right, is actually that's just, you know, a story for consumers. But for example, the you know, the corporate bond, they also have a American feature on the bond. I think, I'm not sure, it's called a callable bond or something, where the corporation can choose a time that they want to call back the bond and pay the bondholder some amount. So it's called callable bond, right? So again, you know, with your imagination, right, the combination of financial products probably is infinite. The point is this, right? You can combine this feature with that feature to make a new product, right? And the feature we've seen so far is this, right? The European feature, which is basically nothing, right? Just a payoff function. The exotic feature, which means your payoff can depend on the whole history. And the American feature, which means the user, right? It depends, actually, either side can choose a random time, can choose an optimal time, right? To terminate the contract and you know, take some payoff action. Okay, so how to handle, right, the techniques to handle each of these features is what you want to think about and learn from the examples, right, that we give out here, you know, in this course, to apply it. Okay, how to think about these things, not specifically learning the formulas and the models and things like that, but how to deal with these quantities. Okay, so these properties. So I hope that that's the message. I do not say that this is easy, all right? I mean, I do not say that if you come and ask me a question on a callable bond, then I'll tell you, oh, this is how you solve it. No, I mean, I'm not that good. But on the other hand, I might try to think about it with you, or, you know, with whoever that is, right? Relying on the intuition that we discussed here. It's the same thing. That's all we can do, right? But you must at least start to realize that, you know, problem with the American feature has the same taste. It can be approached using the same kind of ideas. All right. Okay, I will stop there. Any question before we move on to the next chapter?
So for the question I had earlier, I just wanted to make sure. So for the call, when we have T star, we're
For the call, you mean?
yeah. So like here, I understand now that it's like we want ST to be less than L star. So for the call, we want it to be greater than L star because we want our stock price to go like as high, like go higher. Is that correct?
Right, except for the call. What's that L star?
Um, do we have an L star for the call?
Roughly, maybe, quote. Yeah, do you remember? What's the whole peculiar thing with the call?
Oh, it ended up being just the exercise date, right?
So you can say L star is?
T.
No, no, you're confusing, right? T is time. L star is the level of the stock you wait until you exercise. So L star should be?
Oh,
Infinity. meaning you never exercise early.
Oh, I see.
Right.
Okay.
So the concept is fine, except that L star is infinity for the call. Now that by itself, right, exactly is a question to think about, right? Why is it with the call that L star is infinity? Right. So again, for example, suppose you have a perpetual call. What happens with that? Or why is it that we don't discuss perpetual call? Is it because we're lazy? We don't want to, do that thing? What happens if you have a perpetual call option? With a
Sorry,
perpetual,
I'm not sure. Do we just keep on waiting?
I think so, right? With a perpetual call. So two things, right, that are interesting with a call. First of all, right, I think that was Meet last week. He mentioned this, that a call has no upper bound in terms of like the absolute payoff, right? Because the sky is the limit, right? A put, at most you have to pay K, because stock cannot go negative, right? But a call, stock can go as high as it wants, right? So if you have a perpetual call, at least you can see, right, there's no potential upper bound on how much you get paid, right, from the payoff function, right? So from that point of view, the holder has a motivation to just keep waiting, right? But I don't think that's really it exactly, because there's still the issue of time value of money, right? The longer you wait, the less value you have, right? For example, let's say, I tell you, Sherry, if you wait 100 years, I'll give you $100,000. Does that sound attractive to you? May Does that sound attractive to you to receive $100,000 in 100 years?
No, because I can't use it anymore.
Right, you might be dead already, right?
Yeah.
But so you see that's just a joke. But time value of money, right? We don't want to wait too long, right? Even with a very attractive sum. So, but still, right? I think so. That's one thing. Another thing, though, is but the whole point is, I think the time value of money. If you look back on our solution on why the call option, right, never exercise early, you see that the time value of money points in the right direction for the call. It's kind of weird. It helps the call to raise value, but it points to it points in the opposite direction for the put. It's roughly the story that somehow I feel like, so the longer you wait with the put, the lower you lose the value. But somehow with the call, it's strange. The longer you wait, the higher. So the time value of money works for you in a call. It's kind of weird. Look into it, and then you see. All right. So the explanation is with the intrinsic value. Like how, again, I mean, I guess let me just put it down so you remember. From the put call parity, right? You have the following: V call minus V put, right, is ST minus K, eta minus RT minus T, let's say. Okay. So of course, this is European, all right? This is European. So you have this. Right. And the point is this, because V put is non-negative, and because you see this minus R right here with the minus is helping you, this is strictly bigger than ST minus K. That's what I mean by time value of money is working for you in a call. So V American call, right, by definition is no less than V European call, and is strictly higher than the payoff value. So, if you look at that optimal stopping time, right, this guy never hits that guy, right? This value of the option never hits the payoff function. So because time value of money works for you, so you just can keep on waiting, right? But if you look at the put side using exactly the same equation, you see that V put is K e to minus RT minus T, right? And then minus ST plus V call, right? Like that. But, right, you can, so V call is not negative, that's fine. But you see this, now this discounting is working against you because this makes K decrease. So you cannot say, right? You cannot say that this is bigger than K minus ST. Does that make sense? So these two negatives, because the structure of the call works for you. This negative, because of the positive, does not work for the put. So with the put, time value of money is really time value of money. It hurts. So you cannot wait too long. For the call, for some reason, time value of money does not work against you. Right? That's all I can say. But yeah, but right. So exactly this, fine details, right? How the time value of money interact with the payoff function is also something you have to consider when you look at the American feature of the product. Yeah. Is that too much? You understand the idea a little bit? Hope.
Oh yeah, that really helps. Thank you. I think especially the bit of like time value of money and then thinking about it in terms of both the call and the put, I think that was helpful.
Mm-hmm. Any other question? All right, so let's move on to the next topic. So for the first time in our class, I guess we, well, not really get out of, but we're gonna talk about a new product now, okay? Not option exactly, but foreign exchange. So I don't know what chapter it is here. Chapter something. 9, I don't know. Whatever. Sorry, okay. Who cares? In the note, foreign exchange. So FX, right, is what you really hear about in the option in the market. But I mean, like the technical title is called change of numeraire. But I mean, that's a scary word. This is the mathematical techniques, or this is the math finance technique. But the content, right? I hope the message is at least the main bulk I want to kind of convey to you is the idea of we're modeling foreign currency, foreign exchange, and how to price, okay? How to price foreign exchange, okay? So first, let's just start out right away with the model. So now, for the first time, our model will get a little bit more sophisticated, all right? In our market now, we'll have two products, or more than two products, you will see. But at least we'll have two processes. The first one is our good old stock. Okay. The second one is going to be something I call Q. Like that. Okay. So first of all, let me explain something. This model is supposed to be under the physical probability, so not risk neutral yet. The reason, right, is because mu and gamma. Oh, I'm sorry, not S, right? Q. The reason is because, the rate of return here is not R, okay? So it's not risk neutral. You don't see a tilde here. But anyway, first of all, right, we'll talk about the meaning of this to begin with. But what are these guys, right? So ST is just your good old stock, whatever that is, stock of a company. Q is our new player. Q is a new product, is the foreign currency, the exchange rate. But let me clarify, all right, because here there are two directions, So for the purpose of the discussion, there will be a foreign currency and there will be a domestic currency. And for simplicity, as always, think of domestic currency as US. Foreign currency, probably by default, I will go with euro. But if I think for majority of us, if you think of the yuan, I think that's perfectly fine as well, right? So QT is the exchange rate going this way. In other words, it's going to be the price of foreign currency in terms of dollars. Okay, so it's the foreign exchange rate, basically. Okay, but in terms of dollars. So everything here, right now, unit starts to matter, all right? Because soon enough, I will start introducing products in the other currency, in the foreign currency, okay? So keeping it straight will be important. So when I do so, I will emphasize, right? But here, these are in dollars, okay? So for example, I don't know, suppose, right, I think yuan to dollars now is 5 to 1, I think, or sorry, 6 to 1, whatever, I hope I'm close. Then QT, right, Q0 right now will be 1.6. Is that okay? So that's what Q means. All right, so one more thing, right? So basically we have two products, right? Two products, two assets, two processes. So they have different rates, that's fine. What's going on with this, right? So here we want to make our model more realistic, and maybe it's time to introduce you to correlated processes, okay? Correlated processes. So first of all, right, the deal with this is this, that basically you see the stock and the foreign exchange are correlated, right, or are connected by the W1, for example, right? They are connected by the W1, right? So on the dynamics, right? So I want to make sure you understand how to work with this model mathematically. So first of all, let's just look at DQT, okay? Oh, by the way, I should do this, right? Rho is a number between -1 and 1. Rho, right, definitely is the correlation, coefficient. So rho dW1, 1 minus rho square dW2. So first of all, I want to say that this quantity is not scary by itself. If we let W3 equals to rho W1. Oh, and by the way, sorry, maybe I should say this, right? I take a lot of things for granted. Here, W1 and W2 are independent Brownian motions. So these guys are independent. These guys being independent is quite important, okay? So independent Brownian motions. So if I let W3 be this, then W3 itself is a Brownian motion. All right. Do you see why? Do you see why this is true, or why it's kind of simple to check? Well, what do you need, right? You need several things. You need that it starts at 0. Well, is that true? Sure, because at time 0, right, it's a sum of these guys is 0. You want to make sure it's normally distributed. Is it true? Well, sure, because these guys are normally distributed, right? I mean, increments, right? So basically this, if you want, this is dw, dw, dw like this, right? Because the differential, this is a constant, it doesn't affect the differential. You want them to have the increments to be normal with mean 0 and variance t. Does that work? Sure, because the mean of each of these guys is 0, right? By being by motions themselves. What about the variance, right, is equal to t dt? Does that work? Sure. This is where exactly, you know, this happens because rho square, right, when you look at the variance, plus 1 minus rho square is equal to 1, right? So the variance of this guy, right, is rho square plus this is equal to the dt itself. All right. So I'm not writing it down because I think I'll put that as, you know, an exercise in the homework or, you know, in the review session. But right, I hope that I kind of explained to you why, right? This is a Brownian motion, so it's quite straightforward. Anyway, right, what that means is this, that simply if you just want to look at the exchange rate, it can be viewed like this. So it's gonna be just a simple Black-Scholes model, right, by itself. So that means, right, QT has volatility, sorry, QT has volatility, sigma 2. That's it, right? QT has volatility sigma 2 and mean rate, right? Gamma. So it's the same, okay? But putting it together with the S like this, right, says what? Well, if you look at, right, the return, right? So basically, so dst is mu st dt plus sigma 1 st dw1t, dqt is gamma st dt plus sigma 2, right, qt times rho dw1 plus this. Okay. Then because the volatility of sigma of stock is sigma 1, what it really means is this, right? The variance is sigma 1 dt. Okay, so the variance of the return, right, of the log return, percentage return, right, is sigma 1 dt. The variance of the Q, right, will be sigma 2 dt, you know, coming from what we say here. Okay, what about the covariance, right? The covariance of the returns will be rho sigma 1 sigma 2 times dt, coming from this part and this part. Obviously, right, that goes to the correlation, right? Correlation is covariance divided by the variance square root, which means is rho. That's it, right? So putting the row here, right, allows us to put a correlation structure between the return of the, hold on, let me check if there's a DT here. Give me a moment. I think there's a DT here because you take this, you divide it by the square root. Oh, sorry, wait a second. No DT. Yeah, okay. So basically, right, it's just basically saying that your stock somehow has a correlation, right, in terms of its return structure to the foreign exchange rate. And of course, if the company itself, right, has something to do with, you know, trading or something, right, import, export, and that happens anyway, right, mathematically, we just want to introduce you to a more sophisticated model where, you know, products can be correlated, all right, and the easy way to build correlation structures like this. It's the rate of return, right, quote of the foreign currency, right, Sherry? So in other words, if you look at the expectation of DQT over, what am I saying, right? Not DT, DQT over QT, then that's gamma DT, right? So on average, right, the foreign exchange grow with gamma. It could be decreasing, for example, who knows, right? But gamma is the rate that on average that the foreign exchange grow by. Yeah, but as you will quickly see, mu and gamma will become irrelevant. Why? Because this is not risk neutral, right? So actually, the next topic we want to go to is what is the risk neutral? Okay. So risk neutral dynamics of ST and QT. So let me say this, right? Maybe by now you are used to this kind of thing where, you know, W, right, goes to W tilde, that kind of thing, right? When you change from risk neutral, from physical to risk neutral. So the stock, right, will be R STDT plus sigma 1 STDW tilde 1T. The foreign exchange rate will be R QTDT plus sigma 2 QT, right, rho DW tilde 1 plus square root of 1 minus rho square DW2. Is that correct? And I think it may be unfair here to pose this question, but I don't know if any of you are perceptive enough to see if this is the right structure for the risk neutral framework for these two guys. To answer this question, right, you must know what risk neutral framework means and why we do something like this, why we swap, right, mu to R, actually, right next to Cherry's question, why do we replace, right, the rate of return to R in risk neutral framework? What do we mean by that? So is this right?
To me, it looks a bit strange that they both are just R. Like they're both the same, but I'm not sure.
So yes and no, right, Sherry? For example, if you have two stocks, right, and I think in this class we did not have a chance to go there, but if we have two stocks, stock 1, stock 2, then they will both go to R. and I will explain why. But actually, to understand why, right? What's the meaning of R here? Why do we put that R, right? Again, going back to the question on day one of the class, right? Why do we use risk neutral framework? What does that even mean? What does it mean? So don't forget this, all right? This is super important, and that's just the underlying reason of all the things we do. It only means this: it's an evaluation process. This is what it means. What it really means, right, is that the future value, right, the present value, rather, right, what it means is the present value of one share of V in the future, right, time t is V0. Present means, you know, time t equal to 0, little t equal to 0, right? So what it means is you value one share of whatever that is in the future exactly by its present value. Okay, that's what it means. And you see, that's why this R is there, because its growth rate is R, right? And this is the by motion, which is a martingale. When you discount it, right? Remember the Ito's formula, right? When you do this, basically you take that out. So this being a martingale, right, it goes back to V0. Okay, so risk neutral framework really just to ensure that this happens. So for that reason, okay, that Sherry's remark that both of these goes to R, if they're both stocks, that's fine. Why? For example, right, how much do you value a future share of Google right now? Answer is current value. How much do you value a future share of Facebook right now? Answer is current value, right? So both of them satisfies this criterion. Therefore, right, they both should have rate R in their risk neutral framework. Does that make sense? These are, again, match exactly that discounting factor. So with that, do you value one share, one unit of the foreign currency in the future as the same as the current value of the foreign currency? Or a simpler question is this: if I give you €1 now, or I give you €1 in 10 days, or I mean in a month, which one do you prefer? You prefer €1 in 10 days? Why is that, Cherry?
Wait, sorry. Wait, can you repeat the question?
If I give you €1 now, or I give you €1 in 10 days, which
Oh,
one?
sorry. Now, sorry. I want it now. Yeah.
Why?
Because it won't be like worth as much in the future. I guess maybe not worth as much, but we won't be able to use it. Like,
Yeah, well, not worth as much, I think is right. But
okay.
how much is it really losing in 10 days? Or let's just take a year to make it longer. How much are we losing out in a year? If you receive, instead of €1 today, you receive €1 in 1 year, how much are you losing out?
I think I'm losing out on like the amount times the interest rate because I think I could have invested it like in the bank or something instead.
Yeah, but what kind of bank?
Wait, what kind of bank? Sorry, what do you mean?
I guess that's a weird question, but I'm not sure. I don't think you can deposit euro in the US bank. Am I right?
Oh, okay, that's what you mean. Oh,
So-
okay, I see.
No, actually, I asked this because actually it's going to happen next. That basically you're losing out on euro interest rate. You don't lose out on US interest rate. And
Okay.
that's the difference. So what happens is this. DQT will be R minus RF QT dt. Where RF is the foreign risk-free rate. Is that okay? So in other words, the risk neutral dynamics of QT is that QT will lose out on the foreign risk-free rate like this. So the R still holds because, you know, that's just risk neutral, but it will lose out on the foreign risk-free rate. Okay. Now you may find this a little still a little strange because why this R here, for example, right? So if you want, right, I'm hiding another process behind, which is the foreign money account process. It's defined like this. I will call it NFT, okay, which is going to be equal to E to the RF times T times QT. Okay, what is this? This is exactly right, the value of 1 unit of foreign currency okay, deposited at time 0 but of course the value here is in dollars, right? Denominated in dollars. Is that okay? So basically, I mean, that's a fancy word to say a foreign saving account. A saving account in foreign money, right? Where you see here V0 is what? Q0, right? So in the beginning, it has 1 euro. And then it grows with euro rate. Okay. So it's exactly this guy right here, right? This foreign money account that satisfies this equation. In other words, right, you should value 1 share of the foreign money account in the future as its current value, right? And FT must satisfy an F0 or whatever, you know. Is that okay? So the future value, right, discounted for this foreign money account is exactly its present value because, you know, it's keep growing, right? If you have, you should be indifferent. So I will ask that question to Sherry again, but in the saving account. Do you prefer the saving account, in euro now, or do you prefer the saving account in a year? And I hope, right, I will answer for Sherry too here, that the answer is you should be indifferent, right? It doesn't matter. If you get now, that's fine. But if you get in the future, that's fine too, because the saving account just grows in terms of value. So this is, because it satisfies this equation. Is that okay? So therefore, right, in terms of risk neutral framework, the dynamics should grow with exactly rate R because of this, right? This structure is because it's directly related to the foreign exchange, right? But this R is because it's fair value, meaning you value its future value as the present value, no loss, right? But then of course, if you compare this and this, the difference is exactly the RF, right? The discounting in terms of foreign currency. So I hope now that it's convincing that DQT is R minus RF. Any question on this? This is the starting block of our discussion on foreign exchange. So it's important that you understand all these concepts, right? Why these guys are like this. These three products, right? The foreign money account, the foreign exchange, and the stock, right? The domestic stock, which is quite simple by itself. Any question on any of this? Are we okay on all counts? All right. So we're going to take a break soon, but let me tell you what we're going to discuss next. All right. So of course we introduced these guys, right, to ask questions about them and questions in terms of pricing, right? What product are we having? We're going to have these following products. We're going to have VT, which is, let's say, a very simple product, quote simple. First one is this. What is it? It's going to be a call option on the foreign exchange, right? It's going to be a call option on the foreign exchange. Or if you want, right, this is a call option on the foreign currency, right? You're expecting the foreign currency to go up in value in the future. So the second one we're going to have is something like this. Let me call VF, which will be KF minus okay. Now this is where things start to get a little bit, complex, and you want to pay attention. So this one, right, the unit is in dollars. What unit is this in? What unit is VF in? Oh, by the way, right, for example, right, this one, and F is in, correct, is in yuan or in euro. Exactly, right, in the foreign currency. Correct. Yeah, no, doesn't matter. Who cares? Yuan is fine. Yuan probably is more friendly to our class because we have more yuan user than euro user. In fact, I don't think that we have any euro user in this class. Anyway, right? But yeah, exactly, right? Because of 1 over QT, right? So KF here, right? That's why I use the F. KF here is not the same as K, right? KF is in yuan, right? In a foreign currency. So this is a put option on the dollar, right? This is a put option on the dollar, on the domestic currency, but denoted, right? Of course, in a foreign currency. Is that okay? Now, why call here and put here? It's because these guys actually are saying the same thing, right? This is expecting the yuan to go up. So of course, the opposite side is expecting the dollar to go down, right? So if these guys are in the same direction, right, if you will, right? So for this time call and put actually are doing the same thing in a way. Then what is the relation, right, between these two guys? Okay. And the answer for that is something we're going to say is a put call duality, not put call parity, but put call duality. Okay. Because, you know, they, again, right, they're not put call on the same product. They're put call on sort of opposite product, but similar, right? Okay. So first we'll answer that question. Another question would be how to obviously how to price VT and VFT. Okay. Meaning, right, if I want to find V0 here, right, how do I do it? The third one, though, is this, and actually is related to VF, all right, to VF. Notice this is in yuan, all right. This is entirely in the foreign money market, in the foreign currency, right? So pricing this should kind of make you pause. Wait a minute, right? Before all the process I've learned, right, is in the dollars, right? You discount here in the dollars, right? And then this is, by the way, right, we will start calling this the domestic risk neutral measure, right? Domestic risk neutral probability for obvious reason. It works with products denominated in dollars. Well, it should not, right? It should not make sense for you to do this. Okay, why? I mean, the obvious reason is this is in the foreign currency, right? This is in yuan, and this is discounting in terms of the interest rate applied to the dollars. So this is obviously wrong. But fixing it like this also should not work because this is still with respect to the domestic process, okay? The E tilde here is calibrated for domestic risk neutral probability. So what do we use here? Okay, and that actually is the topic for, so the right answer is this, okay? For now, it's just symbol. But we will need a new measure. This is called the risk neutral probability or measure using NF as numerator. So that will, of course, introduce the idea of change of numerator as a topic. Okay. And finally, we will, of course, mention the dynamics of 1 over QT under P and F. So in other words, right, what is this strange guy or this new guy we're looking at? So basically, if you will, right, so far, we only look at everything from the lens of the US market. This guy right here. From the other continent, right, or in another country, right, in China, from Europe, they have their own way to looking at things, right? Because they'll calibrate things according to their own currency and their own unit, their own, risk-free rate. So obviously you don't expect things to be the same, right? For example, call being put, that kind of thing. But beyond that, I guess there's some more subtle change, right? So QT, right, behaves like this, right? This is our point of view for how their currency is valued by us. How do they look at, right, our currency as valued by them? Okay. Anyway, so these are all questions that we'll be kind of discussing right after the break. But the new idea of introducing, right, the new probability, a new point of view from the other market, right, and using that to price products denominated, right, in their currency is exactly the topic, right, for the next discussion. Okay. So let's take a 10-minute break, and let's be back here at 10:40, right, and we'll begin the lecture again. Yeah, see you. Okay, so I hope everyone is back. Let's start again. So to remind you, right, this is where we left off before the break. We discussed, right, two options. One is on the call option, right, on the foreign currency denominated, right, in the dollars. And one is in a put option on the dollar, right, denominated in the yuan, for example. How are the two related? How are the two related? Okay. So in other words, if we let, right, again here, how can we connect the two? Do you see any way for us to, for example, right, compare this and this? Of course, first of all, they're in different currencies, right? They're different denominations. So what is the first thing that we could do, right, to allow us to compare the two? Well, so you see, one thing we can do is to convert this, right, into the dollars. So in other words, right, multiplying this with cubic T would do the job, right? Would convert this into the dollars. Okay. Now, the plus function, right, has this nice property that constant, positive constant, right, can move in and out of it, you know. So this will be equal to kf times qt minus 1. Okay. And that this starts to look very, very nice because this is kind of, right, looks like that structure already. And, you know, obviously, right, KF is in the foreign currency, so multiply with the exchange rate will become a domestic currency. But to really, right, make these two to be the same, or I mean, not the same, but, you know, on common ground, then we will factor out KF. Whoops, 1 over KF, right? So, well, I guess one last decoration, right? So far, right, this is all manipulation. So if we divide, right, over 1 over KF, this will be and VT is this. Okay. So obviously, right, if 1 over KF is equal to K, then we have the following identities. K QT VFT is VT. This right here is the put call duality. Okay, it's the put call duality. What does it say, right? What does it say? So remember, right, this is still LVF, right? This is still LVF. So what it says, right, is that, so K here, right, obviously denotes the number of shares. So what it says is this, right? So in words, K shares, right, of put options on the domestic currency is equivalent, I guess maybe, right? I must say, with strike, 1/k, right? Because why? Because the strike for VF is KF, right? But we assume that 1/KF is K. So therefore the strike here is 1/K, right? Is equal to, or is equivalent to, 1 share of call option on the foreign currency with strike K. Okay, so that's put call duality in words. Does this make intuitive sense to you? So for me, I think it makes some sense, but I have to admit that somehow, right, the math is okay, but the wording, I guess it helps, but I just, it doesn't seem that obvious to me, like, you know, especially when with the K, the 1/K, that kind of thing. So when we convert, I'm kind of weak with this kind of thing. When we convert from one currency to the next, somehow my mind just kind of get lost in the whole, you know, conversion thing. Okay, but it really is this. So maybe let us try a numerical example, right? Kind of just to check out that things work in that way. For example, right? Let's go back to that fictitious conversion that we looked at before. That, let's say yuan to US dollars now, right? Is, let's say, 6:1. What that means, right, is Q0 is 1/6. So we should look at two options, right? Option one is a call on the yuan, right? With strike, let's say 1/5. Okay, that's okay. According to this, right? According to this, according to the put call duality, this should be equivalent to a put, right? Not a put, 5 put, right? Because it's, oh wait, hold on, K shares, sorry, 1/5 of a put on the dollars with strike 5 yuans. Okay, that's putting it in more concrete setup. Is this intuitive, still more and more intuitive, or so at some point something should become obvious, right? Is this obvious to you that this and this are equal? So again, I have to admit that seems okay, seems better than this wording, but you know, again, this is my weak area. Not sure about you, maybe you will see this quicker than me. Still not quite for me yet. I'm okay with it, right? But so let's check out the concrete idea, right? So what really happens here, right? So the call on the yuan, right, will strike this. So actually, you know, for the sake of discussion, let's suppose that QT is also 1.6, right? Suppose that the yuan, the exchange rate doesn't change. It stays the same, right? From now until the expiration. What that means, right, is with this strike like this, then the call option makes money, right? The yuan, the call option makes money. So in other words, wait, hold on. Am I doing anything wrong? Sorry. Sorry, let's do this. Apologize. Maybe let's change it to 6, all right? So actually, let's say the call is the same 6, all right? And so let's say that the yuan, it becomes more expensive. They become more expensive. Yeah, okay. So, okay. So what happens is, let's say that the strike, right, is set at the same level as a current exchange rate. Okay. So yeah, you're really hoping for the yuan to go up, right? So here it did go up. It goes up to 1/5, right? So the exchange, the yuan becomes more expensive. So right, so the call option, right? Call option payoff is 1/5 minus $16, right? The put option payoff is what? Well, so now, right, the strike is 6, right? But the value of the dollar to a yuan is now only 5. So you also make money, right, on the put option, because 6 minus 5, right? So the payoff on the put option is 1 yuan, right? 6 yuans, right? 6, yeah. Yeah, sure. I'm doing very concrete calculations here. Yeah. So right. So are they equivalent? Well, not yet, right? Because we want to say that 1/6 of the put option, right, will be equivalent to this, right? So in other words, let me try to see here, right? Yeah. So how much is this call option worth in the yuan, right? Translating this call option in the yuan, right, will be call option payoff, right? Because the exchange rate is 5, right? So a call option payoff is 1 minus, right, 5/6, which is 1/6 of the yuan. Right? So you see that exactly, right? This is exactly 1/6 of the put option in the yuan to begin with. Does that make sense? So right, that checks out the put call dot. Any question? Okay. So now, so that's just kind of establishing, right, a quick relation between a put on the domestic, a call on domestic currency and a put on the foreign currency, and vice versa. Now let's go back to the business. Let's go into business of putting a formula, right, to these options. So let's remind ourselves that dQt is R minus RF QT dt plus sigma 2 QT rho dw tilde 1 plus square root of 1 minus rho square dw tilde 2. Okay, so we look at, right, a call option on Q on the foreign exchange, and we look for V0. So V0, right, would clearly be, because this is a dollar product, right? It's a domestic product. So V0 would be exactly eta minus RT times QT minus K plus. The question, of course, though, right? The goal here is because everything like this is just a simple call option, if you will. I want to make it into a Black-Scholes formula. Whoops. Well, is that possible? Can I do so? And if so, what's the answer? Do you think we can apply Black-Scholes formula to this equation? And if so, what's the answer? If not, is there any fix that we can do to apply the Black-Scholes formula here? So first of all, right, the Black-Scholes formula does not apply directly yet, just simple technical issue, because this is R and this is R minus RF. Okay. So this, on the other hand, is no issue. Why? Because remember, right, I said you can view this entirely as just a Brownian motion. So in other words, the QT, which is R minus RF, QT dt plus sigma 2 QT dW tilde 3. Okay, so we for pricing purposes on Q, right, unless you match Q and S together, right, Q by itself, you don't have to worry about this being two Brownian motions. You can just look at it as one single Brownian motion. So in other words, right, that's not the issue. The issue is here. But this is easily fixed because, you know, that has to do with that R. So what we have to do now, right, is to somehow fix that by introducing the RF into our equation. Like that. Okay. Now then, this matches with this. So that exactly becomes the Black-Scholes formula. So this becomes eta minus RF T, right? Q0 ND plus minus K eta minus R minus RF T ND minus, where the plus minus is going to be R minus RF plus minus 1/2 sigma 3, right, square times T minus log of K over Q0 divided by sigma 3 square root of T. Okay. So this is the Black-Scholes formula for the call option on the foreign currency. Any question on this? All right. So now let's proceed to the other one, which is the put option on the domestic currency, right? So we want to find VF0. And so as I mentioned, right, the fact that it's quoted in foreign currency poses a problem because, you just don't know, you cannot apply, right, the domestic, the risk neutral pricing like this directly. Okay. But that's an easy fix for this one actually, because with put call duality, or actually, right, wait, hold on. Can we do this? Yeah. So a possible, I have a possible approach. Let's see how far we can do it. Is, just convert it to domestic currency, price it there, and convert it back. What that means is this, right? That you do this, you convert it, right, to the domestic currency, and that will become, right, QT times KF minus 1 plus, as we mentioned. And now, right, you can price this. In other words, right, you will get E tilde of eta minus RT, okay, which is E tilde of eta minus RT times QT KF minus 1 plus. All right. Now, this makes perfect sense because this is in the domestic product. This is in the domestic currency, right? We converted it by multiplying with the exchange rate, right, from the foreign currency to domestic currency. So we can use the domestic, right, discount, and with the domestic risk neutral probability. But what is this object we're looking at? Well, it should be the original price times the original exchange rate, right? So in other words, the original one that we're looking for will be 1 over Q0 times this. Is that okay? How do we price this? Well, you can factor out a KF and use our Black-Scholes formula up there, right? So in other words, this exactly is, whoops, KF over Q0 and so we're using nothing but our put call duality again, right? So in other words, we avoided, right? We avoided having to deal with anything in the foreign currency in the foreign currency by converting everything back to the domestic currency. Any question? Are the symbols okay for you?
The
Yeah.
expectations just like in terms of like our usual dollar.
Our usual, there's nothing new here yet, right? I mean,
Okay.
there's one thing that's new, which is this converting process, right? But I hope it is there to convert back and forth, and it's pretty straightforward what it's doing.
Okay.
All right, but still, right? Let's try something new. And trying something new is a new approach, right? Which is equivalent, but this will have more, this will open up more windows for us, right? Because here, again, we're relying on this trick of put call duality. You don't expect, right, all the products, right? Basically, suppose you have some product that is really in the foreign currency that may not have any direct translation to the domestic currency, then you really, right, have to use the foreign currency to price it. So a new approach using change of numeraire. So first, right, this actually is an entirely new concept. What is a numeraire? And then how do we define it, and how do we price it? Okay. So first of all, the word numeraire may be a fancy word for basically a unit of denomination. Let me say this, a fair unit. And I'll tell you this, we have been using numeraire in this class without you realizing it. Okay. So what it means is this, right? So suppose NT, right, is a numeraire. And really NT is the value process of some asset. It should be fair value. So I'll talk about that later. Then basically, when you denote something like this, okay, that's exactly our change of numeraire. So what we mean is the price, right, of S denominated in the unit of NT. Is that okay? I hope this concept is straightforward. So basically, for now, right, I haven't really said what can or cannot be a numeraire yet, but roughly speaking, anything can be a numeraire. That's actually the very surprising thing, right? But I mean, maybe not. For example, I mean, kind of going back to my, I don't know if this is a thing for my country or not, but in my country, people somehow do transaction in gold, so you can buy houses with gold, or I don't know, car with gold. At least when I was young, that's the case, right? And so in that sense, right, we are denominating, right, value process in gold, right? Of course, we're all familiar with, right, people trading stuff by the dollars. I mean, in a different country, right? In my country, dollars is also very popular, right? So you can trade things in the Vietnam currency, in the US currency, and in gold, right? So actually, without saying it, right, people are using different denomination already, right? A house is quoted in gold, right? A car is quoted in dollars, that kind of stuff. So, right, denominating the value of a process in some other unit, right? So NT here can be price of gold, for example, is exactly, right, that idea of change of numeraire. So it's not as fancy as it really sounds. So on the other hand, right, seeing this, you see that we have been doing this in this class before. We have done change of numeraire without stating it that way. We have been doing this because when we look at the discounted stock price or discounted price process, what are we doing? What we're doing is we are essentially saying this is that, right? I mean, that's that seems super trivial, but from a financial meaning, what are you doing here? What is E to RT? E to RT, right, is the price process of the domestic money market, right? E to R times T is the value process of the domestic money market. So in fact, right, what we're doing here is we're already saying, right, I'm not measuring the stock price itself, but I'm measuring the stock price in the unit of the domestic money market, or the whole discounting idea, right? Discounting time value of money that we've been discussing so far. A different lens is that you are measuring the value of stuff, right, in the unit of the money market, right? The money market will take care of the time value for you, right? Whatever that is, how it grows. By the way, right, this concept is actually more general. So let me do this, right? Equals to ST over MT, where MT is the value of the domestic money market. Okay, meaning, you know, again, when you hear money market, just think saving account. So I want to say that this is more than just a superficial change of symbol, because, you know, one thing that we haven't touched so much in this class so far is the fact that the interest rate is constant. We'll do it next week, I hope, right, to introduce you to some flavor of stochastic interest rate. But when you convert it like this, right, it really, the more general meaning of E to RT is just the money market. So when you change your point of view and say that I'm simply measuring, right, my stock price of my asset in the value of the money market, then you actually don't care if the interest rate is constant or random or changing with time, because whatever the value of the money market is. So now this becomes a process by itself that you can model, just like, you know, the exchange rate. You model this process, right? And by the way, modeling this process is equivalent to modeling the short rate, right? The risk-free rate. But anyway, the beauty of this, at least, is that if you give me the money market value process, then all I'm saying is, right, my stock price under the risk neutral, right? The risk neutral framework, by the way, the risk neutral framework is the point of view of S as value under the unit of the domestic money market. Okay. So what you're saying is, this is true. Okay. Notice how simple it is, and how, I'm not sure if it's elegant, but what it's saying, right, is that the stock price as measured under the money market is a fair value process. So in other words, right, if you measure under that unit, then its future value is exactly its current value. I mean, you know what I mean, like translating it back to the present. Are we okay with this? Any question here about this? So, right, in fact, you see that you can denote something like this: Pn, P tilde n is basically a probability so that Sn is a martingale under P. So a risk neutral probability, a point of view, right, a framework for valuation under the denomination of n is such that anything, right, denominated under that is a fair value process. In other words, right, the following should happen: Sn at 0 should be equal to E tilde n of Sn t. Or more generally, for any t less than u, S and T is E tilde N of S and U condition back on time T. Any question on this? Again, right, please try to understand the meaning behind this equation, right? And it just says that denominated, right, under the unit of n, this is a fair value as long as I adopt this framework. Now, I haven't spoken, right, about how this framework can be done explicitly, right, in terms of formulas, but abstractly, it's just like that, right? I mean, okay, for example, if you think about, right, if you have, suppose you have something that, let's just say SF, the stock of the foreign currency, right, the stock of Alibaba or something, right, that is, you know, obviously denominated in yuan, right, then clearly, right, if you divide it by the foreign money market and do the, you know, foreign money discount, oh, sorry, under the foreign point of view, that should be equal to is current price. Sorry, 0, right? Does that make sense? So in other words, right, someone who's doing quant finance in China, why do they care about what the US is doing, right? Their model, if you think about it, should start out from, right, their domestic, which is China, right, risk-free rate. They should model their own stock, and they just price things the way they do, right? Us, on the other hand, will have our Google stock, our domestic, you know, money market, and we have the following. Okay. So far, right, you see everything is just consistent. It's just a pricing point of view. The issue, of course, is when, let's say, Google is listed in China, in yuan, or when Alibaba is listed in the US as the dollars. In other words, what is the connection between these 2 points of view, right? Because, you know, because of foreign currency, there is obvious connection between these two. That's the thing to be established, or that's the thing to be studied, right? The point of view of a numeraire, again, I emphasized, right, is a very natural point of view, and I hope you can get comfortable with that. Any question on this? Are we okay? So let me just make a message, okay? Just a message. So final message is, so the main message, right, is this. Oh, sorry, one more thing, I forgot. So this is not innocent. It requires something from the S and from the N. So actually, this is not even technical. One point to emphasize, one point, that in order, right, for both. So let's say this. So the point of view is we start out like this, right? E tilde of, you know, let's say, right, let me switch back to the notation of R. Okay. And then somehow implies that right. So here, you know, this is exactly ST divided by the money market account, right? And there's no division here because the money market account, by convention, starts with value 1, right? So you don't have to have this if you want. I just keep that to make it consistent, but this is just 1 because we start out with 1 currency, right, in there. But the point is this, though, what I want to make is this, that if this is to hold, then the NT itself must be something nice. NT itself must also satisfy. Let me say this. In other words, the denomination, right, whatever you're using as numeraire, must be a fair value process under the domestic measure. It's just like this. It's very simple, really. It's like this. The whole meaning here is that I cannot use the foreign currency as n as my denomination. All right. So if you want to get down to the only message, QT cannot be used as numeraire. And this may cause some confusion to you, and I guarantee it will. The reason is when you do conversion of value, okay? When you do conversion of value, it's QT. QT is the conversion factor because it is the exchange rate. But as the unit of measurement for fair value, so that things like this hold, then QT cannot be. Why? Because QT itself loses value, right? The foreign currency does not earn foreign interest rate. QT itself loses value. So in that sense, if you divide like this, you can see that ST over QT is not a fair value process, right? The right one is the foreign money market. That's the only message I want to make. All right. So in other words, the numeraire, right? You can choose anything as numeraire. Almost, as long as that guy itself is a fair value processing. In other words, it does not lose value in any way, right? When you plug that into your original framework, it must satisfy something like that. It must satisfy so that the property that a share of the numeraire in the future is worth its current price, right? A share of foreign currency is not worth the current value of the foreign currency. So you cannot use that. But a share of foreign money market is worth the same amount, right? It's worth its present value. So that's why. Is this point okay? Any question on this? So this is the foreign money market, right? It can be used as the, it is the choice for numeraire. Are we okay with this? So, right. So the message then is this. Did I write message yet? So message is this, right? The message is, suppose we have, right? The domestic stock. And by the way, right, it's not like I keep rewriting this. I need this because if the stock itself loses value, right, which means it pays dividends, that kind of thing, then clearly if I convert it to a new currency, right, to the foreign point of view, it still loses value, right, because it still pays dividend. The fact that it pays dividend under domestic currency does not change at all if I just look at it from a different denomination. So therefore, I still need to make sure that this also does not lose value, right, by paying dividends and that kind of thing. And so the denomination itself also is fair. All right. Then ST over NT, right? Which we denote as this, is a martingale under this mysterious Pn that I have not introduced yet. And, right, the pricing equation will be for any B denominated in N. All right. So that's the message in short for this section. That is, I must make sure that my stock is fair value, my whatever denomination is fair value, which in this case is the foreign money market. Then I can just price it like that, meaning I just convert everything into that denomination and then, you know, price it under that new measure. Any question here? Okay, so problem, right? How to define P tilde N in terms of P tilde. Okay, so our takeoff point will be from the domestic market. We have a new numeraire, and we want to define a new measure. That's exactly, you know, so if you feel this N is too abstract, just think of this N as the NF that we looked at before. How do we now we want to make sure, right, how to concretely define, right, this new probability. So how do we relate, right? Exactly, this is the question of how do we relate the foreign market to our market? Okay, how do we relate the point of view from the foreign market to our point of view? So the answer is this, okay? By the change of measure kernel. All right, just as before. So what we're doing, right, is going to be defining P tilde N of any set A, right? A is an event, will be the domestic, okay, measure of the indicator function that set happens, but multiply with our numeraire. And also we need to discount it. So I will do this dt, where let me say, right, this dt right here is 1 over MT, the domestic money account. So is the discount process. So in other words, right, you could just take dt to be e to minus RT itself. No problem. Okay. You can take dt to be e to minus RT itself. No problem. Except that, you know, I want to do this so that when we go to the, you know, stochastic interest rate framework, this formulation still works. In other words, right, when I do this, I don't need to refer to the interest rate being constant or not. Okay. So anyway, right, this is the way we relate domestic probability to the foreign probability by using the proposed numeraire itself as the change of measure kernel. All right. You remember, right, before what we did was something like this, right? P tilde of a set of an event is P of that event times ZT. Remember that? Gasanov theorem, right? But we did that in the context of moving from the physical probability to the risk neutral, right? Now we move from the risk neutral to some new ones. But you know, like abstractly, you're just changing from one point of view to the other, right? It's just where you start and where you end. So here you start from physical, you end at risk neutral, domestic risk neutral. Here you start with domestic risk neutral and you'll end up at foreign risk neutral, okay? Foreign risk neutral. If you use the foreign money market account here. And so this whole thing right here plays the role of the ZT, okay? Now you may ask, why all this bell and whistle, right? Why not just NT? Here's the answer, right? For ZT to qualify as a change of measure kernel, we need several things, right? We need ZT to be non-negative, and we need expectation of ZT to be 1, right? So you see, this is a price process itself. It's non-negative, that's fine. But when you discount, right, the price process, you don't get 1, right? When you discount the price process, you get exactly its present value, N0. Therefore, we need to divide by N0 to make sure that this whole thing, right, which is exactly our ZT here, satisfies these two requirements to make it into a legit change of measure kernel. Any question on this? Okay, so to recap, right, by a change of numeraire, exactly this is what we're doing. First of all, we pick a candidate, right, something that satisfies a fair value process, right? It's a martingale, basically, right, under the original domestic measure. Then we construct a change of measure kernel for it, using it, right? Basically just normalizing it, really, nothing fancy, right? The essential ingredient is NT itself, but you do the discounting and divide it by the present value to make sure, right, it's normalized. And then that's how you convert it to the, you know, the other, the foreign risk neutral probability. Any question on this? Okay, so this will have some effect on us, all right, later on. So that's why I need to mention it. But for now, right, the only thing that really matters, I mean, to kind of assure you, right? So let me tell you that things work the way it works. Lemma, that if we use, okay, NF as our numeraire, NF being the foreign money market, then VF0 will be E tilde of E to minus RF T VFT, sorry, E tilde NF. As before. So in other words, what this is telling you is everything is consistent. Everything is consistent in terms of the structure or pricing formula. You still discount, but now you discount using the foreign money market rate, and you use the value of the payoff in the foreign unit. But you have to use this new measure defined like this. And if you do that, then you will get the consistent, okay, value of the product. So concrete example, right, is that put option on the domestic currency we have discussed before, like this. So what it says is this, that, before, right, we need to do this, right? We convert VFT to VFT times QT, and then we convert it back to, VF0, right? That's what we did before. Now, you can just do it correct directly. You just apply the foreign risk neutral probability and do this. Okay, that's all you need. And the answer that you get from here is the same as the answer you get from here with the other answer. Any question? Are you confused yet? So, right, again, just to make sure that I don't lose you, the point is, right, I'm applying, oh, thank you, Don, appreciate it. That's good to hear some confirmation that I'm applying a new point of view, right? I'm applying a new point of view to this process, all right? So before, right, I have to somehow travel back to the domestic currency and use the domestic. So basically, I would rely on QT itself to price 1 over QT, which is fine and which is perfectly legit. It just feels a little bit awkward or not satisfactory, right? I don't know. I mean, right? Why do the European have to somehow transfer their point of view to us to price their own product, right? That's just silly. The Europeans should be able to do it their own way, right? And so here we say that, yeah, obviously you can do this as long as you know how to handle that. Okay. So, but what does it mean to knowing how to handle this? In other words, what does it take to compute this explicitly? I mean, basically Black-Scholes star. Can you tell me? I mean, if you can answer this question and you know what's going on. So I say, right, that this is the equivalent formulation. But if I ask you to carry it out, to carry out this calculation, what do you need? What have I told you, or what I have not told you that would allow you to carry this out explicitly?
I'm guessing we probably would need either NT or exponential minus RT.
Sorry, Don, I'm not following. You mean what do we need?
This is just a guess, but like either exponential minus RT or.
So this one is known, right? It's a constant.
Oh,
I have
known.
to give you, I have to give you the foreign rate for sure. You're right, right? I have to give you a foreign rate, but I mean, it's suppose it's given, right? That I have to tell you that to begin with. What have I not told you actually? You need this.
QT?
I'm sorry?
Nothing.
you need the dynamics of 1 over qt under p tilde nf.
Oh, so it is QT, I see.
Not q, not
I 1 over Q.
correct, right? And again, that's the confusing thing, but hopefully not, because q, right, is the price of the euro dollars to US. If you take the European point of view, then this is the price of the dollar. Wait, did I say it wrong? QT is the price of euro in dollars. So you need to take this as a price of the dollar in the euro. Okay. So if QT is something, right, what is 1 over QT? But 1 over QT not under P tilde, but under P tilde NF. Okay, under the new measure. Right. So again, right, this is going to be the last thing I write. dQt, okay, is R minus RF QT dt plus sigma 2, okay, QT rho square dW tilde 1 plus
And
square root of 1
square
minus
root of
rho
1
square.
minus SQ dW tilde 2.
Yeah,
Yeah,
but
I think I'm used to that.
now you need this. Okay. Do you see the point? And then this will no longer be W tilde, but it will be W tilde Does that make sense? That's what we need. Because now it's going to be completely different Brownian motions. It's going to be the Brownian motion under the foreign money market, for the foreign market, right? The Brownian motion for the Europeans, not the Brownian motion for the US, right? And the exchange rate like that. Do you understand, right? Because you're completely switching the scene to the other market. So you need everything like that. Right? So let me tell you, right? The change will be like this. Of course, the Y will have to wait until next class, but the change will be like this. I hope it's not that strange. Notice the switch, right? Why the switch? Because it's 1 over, right? When one goes up, the other one goes down. And the compensation is exactly the opposite. Of course, this is not simple, all right? You also switch Brownian motions. And that's the important thing. You switched Brownian motions, all right? But now if I tell you this, then this can be computed completely, all right? It can be computed completely. And if you compute this out, it'll be exactly the other one that we talked about. So I'll ask you to explore this, all right, in the review. Yeah, okay, and in the homework. All right, if you have any questions on the homework or whatever, I'll answer it. If not, I'll see you, okay, next Wednesday for the last lecture.
Yeah, I've already asked, like, I think I've already asked my questions during, like, this session, so I think I'm good.
Sure, and then, I think, you have a question on that homework, but I hope that that's just a typo. If you fix that,
Yeah, it was a typo, yeah.
Your program should run, right? If it still doesn't run, let me know, but yeah.
Okay, all right, well, thank you, Professor.
Thank you, Don. Anyone else with any questions?
I finished the homework, but I'm just wondering, because for one of the answers, like I think we're supposed to get similar answers for part 2B and 2C, but I think like my values are off by about 0.5. I was wondering if that's like okay, or if there's something probably wrong with my, like, is it supposed to be really exactly the same for the two stopping times that we set?
Should be. Can you share your screen? Is that possible?
I can. I'll just share real quick.
Okay, let's take a look at what you have.
Great. Okay. Is it showing?
Yep.
Okay. So
Did you fix the typo, by the way?
I just did during the lecture.
Okay, cool.
So like for the analytical, like I got that it's the same. These are pretty much like the same, I think.
That's good. That's a good sign, right?
But
Okay.
the two stopping times that I got, like I've checked my formula, so like I still don't exactly see, but I'm not sure if this like difference is acceptable. It's like 0.
So first of all, right, Sherry,
Yeah.
stopping time are equal path by path. It's not, of course, if it's equal path by path, they will equal expectation wise, but they don't have to, the point, you understand the difference between checking path by path and checking just equal in expectation. Do you understand what I'm trying to say? So in other words, right?
Yeah.
For each path of the stock that you simulate, the first time that the stock hits the value, the first time that the stock hits below L is the same as the first time the value process is equal to a payoff process for each path.
Okay, yeah. I think
so
yeah.
here's this, right? I would suggest that you modify your problem like this. Can you roll up a little bit? Let me see. That's a histogram, right?
Yeah, this is a histogram of, I think it's the part that we talked about in class. So
Wait, hold on. That makes
Wait, I don't think we have like a terminal time for this though.
there's no terminal time, but so
oh
of course,
shoot.
Yeah.
there's no terminal time, but of course you must set some terminal time, otherwise how does the computer run? So the way you do it is you set the t to be very large.
Oh, okay.
So
I
first of
think
all,
can
you
do
may
that?
cut it off unfairly, right?
Yeah.
You
Second,
can do that? Just like set up a terminal time that's really, really large. We can do that.
okay, all right. First of all, you must do it, otherwise your computer won't,
Okay, yeah.
your program won't run, right? I mean,
Oh,
program does not handle infinity. But second, that's exactly the challenge here, because if Sherry does that, then her program will take forever to run because it might be too large, right?
right.
So you have to balance between, so, okay, infinity here may be 10. So big T here, there go to 10 might be enough. Does that make sense? As long as you're, okay, as long as you have your window to be large enough to catch all the hitting time, then you're good. However large size. Does that make sense? So first of all, that's
they're similar now. So I think wait, if I run this last one. Oh, just kidding. This one is different. Oh, because the analytical, I think I didn't put in T. Is T mentioned in the analytical? Sorry.
no.
It's not. Oh, everyone can see my grades.
Don't show anyone anything more. It's fine. I can tell you it's not.
Oh, it's not? Okay.
But let me roll. Can you roll up? I have some issue with your 2A. In your if statement, right? I don't understand the if statement. Can you say if K minus that is bigger and equal to max of that?
This I found really weird too. Can I like, I'm going to pull out I'm gonna stop
Because
really quickly.
that makes no sense.
It does make no sense. Like I was really confused when coding it, but I was following what some of the formulas from like the whole. I'm just pulling out the homework with PDF.
Sure.
Like okay, I think I can share again.
Oh yeah, Dawn, you can share your code too. Sure. After sharing.
Okay.
Yeah.
Oh,
Sherry
I'm just gonna share the homework problem if it's okay, just real quick.
Sure.
Like,
yeah, what wrong?
No, it's just what I took was like, this is VX. So this is.
Oh, I see. But that makes sense. No, but that's VX if you stopped.
Oh, I
Don't you
can't
take the
just
wrong
plug
VX?
this in.
Okay, so first of all, Vx has two definitions, right? That and that. So you probably want to code the whole Vx in, huh?
Oh, the entire, so this thing should be like an actual VX, like.
Absolutely, I would code the whole function Vx, right? Yeah, there you
update
go.
this part to VX. Okay. And
Right?
then,
Yeah,
okay, I see. And then here, I see that the analytics, there's no
no T, obviously not.
T. So I'm just like curious because this one I feel is right because this one is like simpler,
Uh-huh.
but I'm just how does it account for the T then? If
It's
I'm
our star. I'm not sure you're confusing the two. What do you mean by T, Sherry? Okay,
oh,
so
I think I did the same mistake. I only coded this part, but I didn't code the like it's a piece. Is it a piecewise? It is
it's a piecewise, right? Because if your stock is above L, is something is below.
Yeah, the K minus X part was still there, part of like the analytical solution.
Mm-hmm.
So,
okay.
so I got something along the lines of 20 for that one.
Oh, I see. So I should probably just like split it up here as well and find L
Yeah.
star. Right?
Right, right.
Okay.
Mhm.
I will do that right now. I will stop sharing. So Dawn, you can share. Sorry.
Okay, yeah. I promise it'll be pretty quick.
No, it's no worries.
It's fine.
Okay, so this is just like an HTML version of the code that I have.
Uh-huh.
I have managed to get help from the TA about this. So yeah, he told me that like since we don't have a terminal time, we should just do it in terms of like a while loop until we reach
That's
like
fine too. I think what he said is sensible too. You can do a while,
yeah. Mhm.
except the while loop
The,
has an
the
anchor that it may
histogram
not terminate.
ended up ending up really weird. So there's that. I'm not sure if this is supposed to be the result that I need, but this is what I got for both, like part A and part B. I did have to connect the conditions right there. So is that?
So you set L to be the right L, right? I hope.
Yeah. I already set like L up here and A, and also the analytical solution. Yeah. So yeah, I just made histograms for each. And ended up something
You know,
like this.
actually, if
I'll share that post with you.
I remember correctly, right? Sherry said got her stopping time to be quite short for some reason. Like it seems to hit right away.
Oh, sorry. I modified my because my histogram like I modified it the values because like at first it was like a block and then you said we could just change it, so I changed like K. I think I changed K and R, but sigma is like the same, S0 is the same too, but
Okay.
yeah, I just modified it, but like I think that shouldn't, like it just affects our values at the end, but overall it shouldn't have any effect, I think.
So first of all, what's your little n, Don? Like how many values?
100.
100, okay.
Yeah, and the uppercase M is also 100 because when I did 1,000, it just took forever to do 2C, so I just like shortened it to
Can you
100.
hold on? Can you just stay right there? Let me see here. Go down a little bit. Down more. Okay. So yeah. So while S is bigger than L, right? It looks good to me. I wonder if like your histogram is just suffering from a scale issue, like it's just so concentrated around 0 point something. So it, you know.
So maybe I can just like change it so it's the zeros like on the beginning.
You know what? I also want to investigate, you know, like what is really in your tau. Maybe sometimes it spit out some weird value. So I would, oh, so you see right there, it says 100 values right there are concentrated, right? Between 0 something. So
maybe it just depends on like what my K and
Yeah, like if you give it a little
Okay.
more spread, maybe it will
All right.
be able to kind of, right? This stopping time is really weird, right? That's why I asked you to plot
Mhm.
histogram to have an idea where it runs.
So it's okay if we can just like play around with it, right?
Yep, absolutely. No, I
Okay.
mean,
All
to
right.
get a nicer picture. But the fact that your histogram is also kind of somehow go to a negative worries me a little bit. I don't know if some weird thing
Maybe
is
it's just
wrong.
like a scaling issue. I'll fix that.
No, but you see, it tries to take in the negative value or no. Sometimes like there's like a small, you see it goes to negative. I don't know why, right? So definitely try to play with the, but do you get the expectation to be equal to the V?
Yeah, about that. When I tried doing like lowercase n equal to 100 and n equal to 100, I ended up getting a really big solution that's nowhere near close to the analytical solution. So when I did this, then I got something that was close to the analytical solution. But like, I can't help but feel something's off. But this is what I got.
And why 20 is so nice, right? So clean. Why 20?
Yes. That was just like the solution for the analytical solution that I had up there.
Do you pick some special A and L?
It looked like
Oh, L
S
to
will
be
be 100 and A and L defined.
K to be. Wow, it's so clean. Wait, hold on.
Very.
That means it stops right away. Is that why?
I think it might be because like the S0 might be less than L, so I just got to return with something like this.
That's right. So actually, I think because you just immediately land on a stopping region. That's why. So to make it
Yeah,
more interesting, right,
probably.
you should try something to be in the continuation region, right? I think maybe that also affects your histogram. You see, Don? I mean, if you start where you stop, then there's no stopping time.
Yeah.
Does that make sense? If you start such that your initial stop price is below L, then there's no stopping time at all, right? You just stop.
Right. So
That
would I
might,
need to change the
so I would
L
recommend
or
outputting L star, right?
L star? Okay.
The
Yeah, my
L,
L star is be this.
and see if it's below or above your S naught, how much below or above your S naught, right?
I checked. It's above S0.
No, that's no good. That's
Okay,
exactly
but
why.
okay, so if that case, when I need to change like R or K or something.
You want to yeah, switch things around a little bit because again, right? You see,
Okay.
you stop when S naught is below L, but you're already below L.
Okay.
So
I,
that no
Right.
wonder histogram is like that, right?
Yeah.
well, I
Okay.
actually
So
got
I think I'll change L star for that. Okay.
Yeah. Sherry, you say something?
oh sorry. I actually got something. I think I got the same thing as Dawn, which is really weird. I got analytics solution is 20.
But again, right? What is your L? What is your S0? What is your L star?
I changed it back. So my L star, I just like it depends on the other ones. I have let me just see if I can compare with Dawn real quick because I find it's really weird that we both have 20 exactly.
Well, print your L star and print your S0.
Okay.
I have printed L before, but these are conditions and I know it's like over 100, so that's why I got like a clean 20 earlier.
Yep.
So that's what I know.
Notice your K is too high, right? Your K is too high. I think it's my fault. Maybe I give you that value. I forgot. But basically, your K is too high, which leads to your L being quite high, which may be above S0, which makes you stop.
Right. So do you think it's best for us to like change the L star so that it's like less than S0?
Yeah, so but you don't want to change
Okay.
the L directly, right? You want to because the L is tied with a stochastic.
Right. Like
So
R and
change the
R.
K, change the R, change the S, right?
Okay. All right. I'll see. Okay, so I'll see if I could just play around with that to see if I get like a good result.
Okay,
Okay. Well, thank you.
sure. All right. I think we're happy.
Wait, sorry.
Yeah, sorry.
I thought I got it, but then I lost it. So for the analytics solution, we do a piecewise. What I'm confused by right now is the Monte Carlo simulation that I did for VX, is it not just using that like
No, it should, the whole Monte Carlo is that you simulate your stock up to time tau star and then discount back and add.
oh, I see. So okay. And then we only use any of the stars or for the analytical one. It shouldn't be up there.
Well, we also cheat a little bit by using the L star to calculate our tau star, right? Otherwise, we don't know where to stop. So we did cheat, right? But this is not like completely cheating, like plug in the analytic. But do you understand what I'm trying to say? Like
Yeah.
without the analytic solution, we don't know what L star is.
I see. Yeah. Okay. Yeah. That was the part I
But
was
then once you know the L star, then you should do everything else Monte Carlo.
Okay, I see. Yeah, just making sure. Thank you. I
All
think
right.
I'll resubmit it as well. Okay.
Okay.
Thank you so much.
All right, Sherry. Take
Bye.
care.